Good morning. This is Mayor Valensky with Driving Markets. Okay, let's kick off. So last week, the Fed gave the all clear to the 23 Wall Street's biggest banks. They've all passed the Fed's stress test in terms of extreme economic downturn or in recession or any types of crisis. The Fed introduced back in 2009, 2010, a stress test. And the stress test was to identify the bank's viability in case of adverse economic conditions, like the banking crisis of 2008. Surprise, surprise, every bank passed the test last week. Not only did they pass the test last week, they passed the test last year. In other words, the Fed has written this test up, and all the banks seem to have a provision that they get 100%. There were a few concerns. However, they all passed with flying colors. This is great for the banks. Why? Because the banks now have to have a lower cash requirement. It's quite simple. They don't need to keep that much cash on reserves or available in spite of a recession, which we're in. Now, it might be a technical recession, but we're in a recession because small businesses are feeling it. Yet, the banks are absolutely given 100%, no problem at all, you're all okay. We've just gone through the biggest banking crisis since 2008. It's true the regional banks are not giving a stress test. However, in a recession and a downturn in the economic activity, what you are going to have is you're going to have defaults on credit cards and defaults on loans, which are mainly loaned out by regional banks. However, the other banks, like Goldman Sachs, like Morgan Stanley, did get a forced or an opportune banking license back in 2008 in order that they can get more government handouts and more taxpayers' money when they do fail. And the banks are going to fail. We are going to see another banking crisis, and their liquidity is devastated. They don't have the cash on deposit and they don't have the liquidity in order to ride out the storm. However, the Fed wants the public to be fooled, everyone to turn a blind eye and just move away from this and say, you know what, forget the banks, don't pay attention to it, keep on buying stocks in the stock market. And yet the stock market keeps going up. Fundamentally, the stock market should be going down. However, the stock market's going up because, as we all know, the market makers in the US and globally are manipulating prices higher because it's good for them in terms of asset value. As they push those prices higher, they get more revenue, and also the value of their individual stocks and the portfolios that they are holding rise in value. Therefore, it makes out that they are good, solid investments when effectively the market should be going down. Apple's reached a $3 trillion valuation, or even higher than that, on the back of what? Why has Apple gone above $3 trillion? Purely because prices are pushed higher. The tech sector is going up on a visual metaverse, on a visual unrealistic virtual basis. Why? Because of AI, ChatGPT, Apple going into the metaverse, obviously Facebook's developing metaverse. So this virtual reality is exactly what it is. It's virtual. It's got no basis to it. AI will end up in 18 months being out of control. It will start running its own systems, start developing its own knowledge, and then we'll have to contend with this virus of AI, which is going to be a greater and worse than the pandemic of COVID-19, the Chinese flu of 2021, 2022, and 2020. So we've got major problems that are building. However, Wall Street just wants to ignore them. Why? Because it's in their interest to push them higher, and it's in the interest of the Fed to make everything look rosy, and therefore fooling the public that eventually Joe Public doesn't think there's a recession and they buy their way out of a crisis. However, the banking crisis is going to hit us like a stone wall driving at 180 miles an hour. And what will happen is the Fed will be obliged to print more tissue money or more paper money in order to bail out the banks that are already in crisis mode. And that will end up pushing up inflation even higher. So my medium to longer term view is that the crisis in the banking sector will get deeper and greater, and then that will throw out all of the traders, investors, and the retail public that bought shares, blow them out, so suck them in, blowing them out, and they'll end up having significant losses, and then we'll end up entering a major bear market down by 25 to 30%. Why am I saying that when the markets are moving higher? Because I look at fundamentals, and fundamentals, there's no reason why these stocks and these shares, based on interest rates and based on inflation, should be this high. But all of that has been disregarded and discounted by the market makers and by Wall Street and the other banks globally. And yet, as interest rates rise, stock markets rise. Stock markets do not rise when interest rates rise. Stock markets fall when interest rates rise. But in this particular economy, which is manufactured and configured by the Fed, the US Treasury, and Wall Street, all of them in cahoots in order to drive these markets higher, to suck in the public, to give the public the false feeling that everything's absolutely fine and dandy, is misleading, misrepresentative, and what's going to happen is it's going to end up going down. The banks themselves will lose huge amounts of money on loans and credit cards, as commercial real estate has not even yet been figured into the banking crisis, and yet there is a major problem within commercial real estate as offices are being relocated, buildings are being abandoned, and landlords are being left with a bill to pay the banks and their mortgages where they don't have enough money. So the liquidations will increase in the US and in Europe over the coming months, and that will create one of the biggest banking crises, greater than the 2008 one, and we're going to see huge falls in financial markets. On the positive side, once the huge falls come and then the fundamentals are normal, then you'll see a market rising, and that'll be a more solid growth than the artificial jumping and pushing up of prices that you have at the moment. You can buy my new book on Amazon. You can subscribe on this channel, you can share, you can comment, feedback. Meir Walensky, Driving Markets. Have a good day.